Good afternoon and welcome to Scotia iTRADE's webinar. Today's presentation is on In a Bullish Market with the Montreal Exchange. So you should be able to hear us now. Before we get started though, let's just take care of some quick house cleaning items. Your audio, if there's any difficulties, if you're having any issues with the audio quality, you can always do a sound check by using the link that you see on the screen there. You can just click on that link on your GoToWebinar tool to check your audio quality. Now, if you're using your computer and the quality is not great, you can always switch over to the telephone by using the access code there. Dial in using the access code, and it'll ask you for your audio PIN. You can just type that in as well too. As a quick reminder, we are going to be muted for sound quality purposes. Though you might not be able to speak to me, you can always address us by using the hand tool or by using the question panel. Now, as a quick reminder, I've updated the disclaimer here. Quick read for you. Unless otherwise expressly stated by Scotia iTRADE, seminars, webinars, and other educational tools and resources, collectively content, are provided by independent third parties that are not affiliated with Scotia Capital Inc. or any of its affiliates. Scotia Capital Inc. and its affiliates neither endorse or approve nor are liable for any third-party products or services, third-party content, or investment loss arising from any use of the content, including third-party content. We also, will not solicit any advice from Scotia iTRADE. You won't solicit any advice from Scotia iTRADE. And in making investment decisions, you won't consult with or rely on our advisors and not on your own advisors and not Scotia iTRADE. You'll seek your own professional advice regarding the appropriateness of implementing strategies before taking action. All the information that we present here are just for educational purposes and are not intended to provide any sort of recommendations or advice. So, back to the presentation. The toolbar that you see there in the corner of your screen can be used to minimize or to open back up the toolbar itself so that you can use it. You can also view in full screen mode. And as mentioned, if you have a question, you can use the hand tool, but preferably the question box might be the best way to go. And our presenter will either address them directly as you introduce them, or we'll save them for a question and answer period at the end. There is going to be much information in this particular presentation, so it'll be a full dance card here. We will be recording today's session, and of course we'll email you a link to that recording within 1 business day. Alternatively, you can always visit our YouTube channel, Webinars on Demand playlist, where you can find the archive copies there. Or just email me at education@scotiaitrade.com, and I'll send out a link to the recording as well as the PDF copy of that. Speaking about PDF, we will be downloading or uploading on your part a PDF of the presentation for you, so that as you listen to the presentation going forward, you can also view the PDF. I'll provide that right after the presentation. It just takes a few seconds. So once our presenter is finished and I've wrapped up, just give me a few more minutes and I'll have that up for you. Just a quick reminder, the presentation today will be by the Montreal Exchange, or representative of. Montreal Exchange has a learning series, an options learning series, and we've been going through that on a regular basis throughout the year. Today, we are on Series 5, Implementing a Trading Strategy, Part A, in a Bullish Market. So, as I mentioned before, you can always go back to the YouTube platform to find the previous versions of these, and we'll continue to work through these again in the coming year, as well as some new content. So our presenter today is Jason Ayres. He's a Montreal Exchange instructor. He works with DMS. He's been an instructor for the Montreal Exchange for several years and actively advocates and educates investors on the practical utilization of options for managing risk, cash flow, and leverage. In addition to the development of numerous strategic relationships with some of the most prominent brokerages and exchanges in North America, Jason is the president of Learn to Trade Global, as well as the founder of OptionsSource.net. He's a derivative market specialist by designation. My apologies, DMS is the Derivative Market Specialist acronym. So at this point, I'm going to turn you over to Jason, who will be facilitating the remainder of the presentation. And then I'll return at the end just to kind of wrap up. So here we are with Jason. Jason?
All right, good stuff. Well, thanks very much, everybody, and Conley F. for the introduction. We're just going to share my screen here, so you should be seeing the title slide for today's presentation, which is titled Option Strategies for a Bullish Market. Once again, just want to make sure that the audio and video is working for everybody. So if you wanted to just use that little hand sign within your control panel, you could let me know that that's working for you, and we'll certainly get started ASAP. All right. Okay, so as mentioned, option strategies for a bullish market. As always, we just want to make sure that everybody understands that you know, this information is for educational purposes only, and not unlike any financial security. You want to make sure that you understand the risks associated with investing or utilizing them within your investment portfolio before you go out and actually start doing it. Now, we've got a lot of content to cover here today because there are quite a few strategies that you can utilize to take advantage of a bullish market environment. And by no means does this list cover every single one of them, but we want to start simple at first by looking at purchasing a call option as a stock replacement strategy. We'll move into constructing a bull call spread as a way to lower our capital allocation and risk exposure effectively, utilizing a combination strategy. We'll talk about implementing the covered call strategy as a way to benefit from holding the underlying security in a bullish market environment while mitigating volatility and generating cash flow. We'll talk about put writing as a way to position yourself within a bullish market environment and also as an income generating strategy, and then we'll move into what's referred to as a bull put credit spread, which is a way to effectively generate income in a bullish market environment, and then we'll wrap things up. So we've got lots of information here to cover. As Conley F. mentioned, if you do have questions, typically what I like to do, unless it's something extremely pressing that needs clarity, is just move through the presentation and then give some time towards the end for everyone to sort of digest the information and then subsequently ask the relevant questions. So let's jump right into it. Buying a call option is probably one of the more simpler ways to participate in a bullish market environment. The idea is, of course, you are of the belief that the stock or exchange traded fund is going to increase in value, and as a stock replacement strategy, so rather than purchasing the underlying security, you're going to utilize a call option. So this actually allows us to leverage our capital because we're able to control a large number of shares with a small amount, and so this actually allows us to leverage our capital. And we're also limited to our risk exposure. The value of being an options buyer is that you can't lose any more than the premium that you've paid. So when you purchase a call option as a stock replacement strategy, you still have the benefit of the upside of the underlying security within the time frame that you've allocated, but you have a defined risk exposure, which you know, gives you the peace of mind on a day-to-day basis of knowing that you know, what you have invested in the opportunity, you have a specified and limited exposure to. You can't lose any more than that premium. So an example that I thought I would utilize for illustration purposes is AEM, which is Agnico Eagle Mines. and trading at $60 per share, and this was on just the other day. So if we look at purchasing 100 shares of AEM at $60, we would be required to put up about $6,000. Of course, this doesn't include trading costs and commissions and that sort of thing, but for comparative purposes, to buy 100 shares, we would be putting up about $6,000 worth of capital. Now, one of the things that we need to realize first is that our risk is undefined. So when we buy those shares and we pay $60 per share, we really don't have any sort of defined risk. We may have a risk management plan, which you absolutely should have, but ultimately, if AEM dropped, let's say, in the overnight trading session or pre-market trading session by $3 or by $5, we have no defined limit there. Now, of course, the opportunity is that let's say we had a target of September of $70 per share. Well, if we purchase the shares at 60 and we sell them at $70, we've been able to generate a $10 profit. So there is a risk-reward consideration there, but the challenge, of course, is that your risk is undefined. So when we talk about using options as a stock replacement strategy, what we might look to do is we might look to purchase a September expiration $60 strike call option. Now, at the time that I was looking at this example, that option was trading at $5 per contract. So just to go back to Options 101, we understand that one option contract controls 100 shares of the underlying security. So when we buy that one contract, the premium is listed on a per share format, which means that the cost is going to be $500. So right away you can compare that leverage opportunity. If we bought 100 shares at $60, we would be putting up $6,000. If we buy one call option at the $60 strike and it's $5 per contract, our capital outlay would be $500. Now, immediately, what we know is that our risk is limited to that $5. Now, that doesn't mean that you have to assume that entire risk. It's important to remember that you can close your position at any given time. So if you are analyzing the stock and you have a feeling based on your technicals or based on news within the market that maybe AEM is going to go down instead of up, you could cut your losses at any time. But understand, worst case scenario, you are limited to that $5 per share, and that maximum loss is only realized when all the time runs out of the option contract, which would be the third Friday of September. Now, the opportunity here is that you still have the benefit of the upside, but recognize that the option premium, that $5, is a cost. Okay, so we are buying that contract. That $5 is the cost of that contract. So when we're calculating the profitability of the position, let's say the shares go from $60 to $70. Well, if we have the right to buy the shares at 60, we can then sell them for 70. So there would be an intrinsic value built into that option contract reflecting that difference. So the option contract itself would be worth $10, but we have to extract that $5. That $5 that we would have paid on April 24th is in fact reflecting time value, and it's also reflecting market expectation, which is another term for volatility. So we're paying for time value and we're paying for implied volatility. That's why the premiums for a lot of these gold and mining stocks tend to be a little high, because those stocks tend to be quite volatile. So we need to, if we hold this position all the way to expiration, we need to extract that $5 premium out of the equation, and you have your ultimate profitability. In this case, we risked $5 for the opportunity to make $5, right? So that's the stock replacement strategy. Now, one of the considerations when we're trading any market environment is we're always looking at ways that we could limit our risk and also manage some of the different pricing variables that are factored into the purchasing an option contract. So the bull call spread is another bullish strategy that we can utilize to lower the cost of our trade, but also to mitigate some of that implied volatility variable that's factored into the to the cost of the option. What I'll suggest is, if you're not sure what I'm referring to when I'm mentioning implied volatility, recognize that there are a number of presentations where we talk specifically about spread strategies, but where we also talk about implied volatility that you can reference in the video library that Conlioff mentioned at the beginning of the presentation. So to take a look at a bull call spread, again, the first consideration is we need to have a bullish outlook. So we want to have an expectation that there is that the underlying security is going to move up in value. We're going to buy one call option, and then we're going to simultaneously sell another call option with a higher strike price. In this example, we're going to use the same expiration date, but keep in mind that you can modify this if you want to get more advanced to use different expiration dates. So that's one of the great things about the options market, is you can actually really combine all sorts of different expiration dates and strike prices to meet your objectives. But a simple bull call spread involves the purchase of a call option and then the simultaneous sale of another call option at the higher strike price. So once again, in this example, I'm going to use Agnico Eagles because, the one comment that I made in the last slide is that the $5 premium, might be a little costly, considering the fact that the AEM is a volatile stock. So volatile stocks that move around a lot tend to have a high implied volatility premium factored into the cost of the contract. So if we take a look at the exact same parameters here, we've got AEM trading at $60 per share. We're going to look at purchasing the September call option at the $60 strike. That $5 is a debit to our account. But we're going to turn around and we're going to sell one September call option at the 70 strike, and we're going to collect $2. So we've got $5 going out of our account. We've got $2 coming into our account. So the net cost of the trade is actually $3. So you'll see what we've done immediately is we've lowered our cost basis. So when we lower our cost basis, we lower our break-even point, and we also lower our risk exposure, right? And the other consideration, for those of you that are a little bit more advanced and you understand the concept of implied volatility, if we are paying for implied volatility within that 60 strike call that we bought for $5, we are in fact selling implied volatility when we're utilizing that $70 strike call, and we're collecting that. So what happens is we create what we would refer to as a volatility neutral position. So we take the swings of implied volatility out of the equation, and we create a much purer exposure, for lack of a better word, to the underlying stock price fluctuation. So if we dig a little bit deeper into this strategy, the maximum profit that we can extract from this opportunity is calculated by taking the spread differential, which is the 60 strike, which is the 70 strike minus the 60 strike, so that spread differential is $10, and subtracting the debit from that we've actually incurred for putting this position on. So in this example, the $10 spread minus the $3 net debit to our account means that our maximum profit is $7. You can see immediately how what we've done is we've lowered our risk exposure, but we still have a fairly attractive rate of return. We've actually, if we look at the comparative numbers to just buying the call option, where we paid $5 to make $5 if the stock hit 70, within that same time frame and with that same target, if we used a bull call spread, we would pay $3 to make $7. So we've actually skewed the risk-reward profile a little bit more in our favor by utilizing this debit spread. Now, I don't want to suggest that the debit spread is always the approach that you're going to take, But if you're trying to offset the cost of an expensive option contract, if you want to try to create a better risk-reward scenario for yourself, then it's certainly one that you can consider. Now, the other thing that we do effectively by creating this spread strategy is we lower our break-even point. So when we're trying to figure out what our break-even point on expiration is for a call option purchase or for an option trade, we need to take the strike price and add the debit. So again, if we compare the break-even point to our first example by just purchasing the call option, our break-even point would be the purchase strike of 60 plus the $5 debit of the call option, and we would arrive at a break-even point of $65. So what that's telling us is that on expiration, the shares need to be trading at $65. Well, it's more safe to say a little bit above that to calculate for commissions. But so we need to see that stock above that $65 on break even, or sorry, on expiration for us to break even. With the bull call spread example, if we take the purchase strike of 60 and we add the debit, then our break-even point is actually 63. So the stock doesn't have to move as far within the time frame in order for us to break even on the trade. So that's what I actually find very attractive about considering the bull call spread for different opportunities, is because when you lower your break-even point, you actually the stock doesn't need to move as much in order for you to meet that particular level. And of course, the sooner you meet your break-even point, the closer you are to profitability. So one positive consideration for the strategy. So again, purchase strike price plus the debit, 60 plus 3 equals a break-even point of $63. And of course, our maximum loss is the net debit, which is $3. And that comparative to the long call option again is $2 less. So we reduce our break-even point, we reduce our capital allocation, and as a result, we reduce our risk exposure by considering the bull call spread. Okay. Now again, keep in mind, everybody, you know, if you're taking notes, we'll dig into some of these questions towards the end. In fact, I'm not seeing any questions at this point, but if there's anything pressing at this point, please feel free to type in, and if it's something that I can answer now, I certainly will. If not, we'll just save it to the end. We're going to move on and sort of switch gears a little bit to covered call writing, because the first two examples that I shared with you involve options positions only. And to circle back to those examples, or to circle back to those two strategies just quickly here, recognize that the call option you can purchase inside and outside of your registered accounts. However, the bull call spread, you are not permitted to use that strategy in your registered account. So those of you that are sort of thinking, hey, this might be a great idea for my RRSP or my TFSA, recognize that you cannot use the spread strategies within your registered accounts, but you can buy a call option on its own, independent of the underlying security, right? So we're going to move on to creating a strategy for a bullish market environment that involves owning the underlying security. And the reason why we would consider this strategy as a strategy for a bullish market environment is that your risk first and foremost is associated with the position that you have in the underlying stock. So you want to make sure that when you're looking to implement the covered call strategy or the covered call writing strategy, that you are confident and comfortable with the stock that you've purchased, because that's where your risk lies. And then what you're going to do is you're going to add an options overlay by way of the covered call strategy, so that you can mitigate some of the volatility, and you can generate some cash flow here. So Lynn just had a quick question, just to circle back to the spreads, that we can't buy call spreads. So just to reiterate, you can buy a call option on its own inside and outside of your registered accounts. So in other words, your RRSP, your TFSA, your non-registered margin account. You can buy call options. That's something you can do. For the spreads, you can only do them in your non-registered accounts. Okay, so you can't do a spread in your RRSP. You cannot do a spread in your TFSA, but you can do these spread strategies outside of those accounts. So hopefully that just clarifies that there's some limitations with some of the strategies that you can use in your registered accounts that you want to be aware of when you're looking at creating a plan for yourself. That said, the covered call strategy is another example that is permissible in both your registered and non-registered accounts. So if we take a closer look at how this strategy plays out, you either are going to buy or you already own shares of an ETF or a stock that you're comfortable holding, and you're going to basically get paid a premium up front for taking on the obligation to deliver the shares at a specific price within a specific time frame. So basically, somebody is paying you to take on an obligation, and that obligation is that you're willing to give up the shares at a certain price within a certain time frame. So let's look at this and try to understand it in the context of an actual example. So I was looking at Tech Resources the other day as well. Shares were trading at a nice round $30. So if we were looking to buy 100 shares of Tech, then you're talking about a $3,000 capital outlay. Now, again, keep in mind, guys, this is for illustration purposes only. So what we were able to do based on those market conditions at the time is we could sell one May expiration 32 strike call option for 65 cents. Well, what does that mean? Well, what that means is somebody is willing to pay us 65 cents per share if we are willing to give up that stock at $32. So understand that we don't have to give it up until essentially, well, you know, if we give it up, we're going to get paid 65 cents. Now typically, nobody is going to want to take that stock unless it's trading above 32. So what that means is if the shares stay at 30, if they go up to 31, if they go to 32.50, then that option that we sold expires and we keep the 65 cents. If the shares go to 32 and trade beyond, we'll sell the shares for $32, but we'll also get to keep the 65 cents. So what this basically means is that for 25 days, so between April 24th and the May expiration, we are prepared to give up the stock at 32, and we're okay getting paid 65 cents per share to do so. What this means is that regardless of any capital appreciation on the shares, so regardless of what the shares do, we've immediately generated a 2.16% cash flow for a 25-day obligation. All right. So Neil just had a question. Neil, I think what I'm going to do, because you're asking about a bull put spread, is I'm going to defer your question towards the end, because we're going to talk about the bull put spread when we towards the end. So I'm just going to defer your question till we get to that strategy for the benefit of everybody else. So again, 2.16% immediate cash flow. Well, let's take a look at what this would look like in the event of a couple of different scenarios. So let's say on the third Friday of May, if the stock goes up to $35, well, we actually lock in an 8.8% return. Now, we get the $2 appreciation from $30 to 32, but we give up all the opportunity beyond that because we've had somebody pay us 65 cents for that, right? So the $2 plus the 65 cents equates to about an 8.8% return for that time period. If the stock just goes up modestly, stock just goes up to 32, we still make our 8.8%. We get the $2 per share appreciation from 30 to 32, plus we get the 65 cents premium. If the stock stays the same, well, guess what? We get that 65 cent premium still. The options expire worthless. We keep the premium. We've just locked in 2.16% for a 25-day holding period. Now, keep in mind, if the stock delivers a dividend within that time frame, that's ours as well. So we get the benefits of being the shareholder, we get to collect dividends, plus we get the premium, and if the shares are not trading above 32, then we keep the shares and we can continue to do this. The other benefit to this is that we're also mitigating the volatility of holding the stock. So for example, when we collect that 65 cents, that actually lowers our cost basis, right? Technically, it's, you know, we pay $30, but we collect 65 cents, so we've actually lowered our cost basis to $29.35. So what this means is that if the stock goes down a little bit within that time frame, we could actually still make some money. So if the stock goes down modestly down to $29.50 within that time frame, the typical investor will be down the 50 cents, but the covered call writer is actually still up about 0.5% within that time frame. You know, not a lot, but what you've done is you've mitigated that volatility. So if you're doing this strategy on a month over month basis, the more premium that you're collecting, right, the more you're offsetting any volatility. So think of it as kind of, you know, if every 25 days, for example, I can collect 65 cents per share, that 65 cents per share is lowering my cost basis and in fact, you know, lowering the volatility of me holding that position. If we get a much more significant drop, so let's say the stock drops down to $27, which would be a 10% drop in value for the typical shareholder, we've actually offset that 10% drop by 2.16%, meaning that while the average investor is down 10%, we're only down 7.84%. It's still, we're sitting at a loss, but again, it's going to be a lot easier to recover from a 7.84% drop than it will be for a 10% drop, right? So therein lies that mitigation of volatility that I think is so important in considering this strategy. So another alternative to generating cash flow in your portfolio is put writing. And so the reason why we would look to sell puts is because we have an expectation that the stock is not going to drop in value or not drop by much, and we're going to get paid a premium to sell the put and take on the obligation to own it in the future. So in this case, we don't own the underlying stock, but we may be obligated to own it in the future, and we may want to own it. So selling a put option in and this is only permissible in a non-registered account. So Barb's question just very timely in that we cannot do put writing in our registered accounts, unfortunately. But outside of our registered accounts, it becomes a very effective way for us to get paid to wait, right? So we get paid to assume the obligation to buy 100 shares for each put that we've sold. And again, this obligation is at a specific price, and it's valid within a specific period of time. So just so that you guys can wrap your heads around this a little bit, from a risk profile standpoint, an at-the-money covered call and an at-the-money put right have the exact same risk-reward profile, right? So the put right is in fact no more risky than the covered call right. In both circumstances, your risk is the underlying security, whether it's your purchase price or the strike price of the put right, less the premium that you've collected. Okay, so selling put options is not necessarily any more risky than implementing the covered call strategy. It's just a different way to position yourself in the market. So an example here would be, let's look at Sun Life Financial, which was trading at $49 per share. So I might think, okay, you know what, Sun Life is at a nice little pop. Wouldn't mind owning the shares at 49. It looks like a good value at this price point. And hey, the June 49 strike put option is paying $1.30 per share. So I can just keep my money in cash. I can sell this June strike put option for $49, and if the shares stay the same, or sell the 49 strike and collect $1.30 per share, and if the shares stay the same or go up in value, then I've actually collected $130 for my obligation to buy those 100 shares over the next 53-day period. So it's a 53-day holding period, but that actually brings in about 2.65% within just under a 2-month time frame. Right? So when we're implementing this strategy, I think the important consideration is that you don't care whether you own the stock or not. So if the shares drop below 49 and you get assigned to buy them at 49, you want to be comfortable owning the stock. Now, of course, your cost basis is going to be the 49 strike less the $1.30 premium that you've collected. So you're talking about the $47.70. So what you've done by selling that put option, if in the event that you take possession of the shares, is you've lowered your cost basis by the amount of premium that you've collected. So the neat consideration for this strategy is that as you're selling these put options on a monthly basis, as soon as you're assigned, right, you're going to take possession of the stock. Well, you've already generated some cash flow over a month or so period, and then you can turn around once you've taken possession of the shares, and you can sell calls against it, so you can continue that cash flow. Now, John's question is, what if the stock drops dramatically? Can you get out of the deal earlier? Well, yeah, you can. So you would have to buy that put option back, so you can close the position at any time. So you sold it for $1.30. Let's say the stock drops dramatically, and you have to buy that put back for $2. Well, your maximum risk, or sorry, your loss on that position is 70 cents. Right? So so consider that the same risk reward as if you, well, not so much risk reward, but consider it the same risk exposure as if you bought the stock for $49 and it just dropped, right? Except the difference is, of course, if you bought the stock for 49, you have that dollar, you don't have that $1.30 buffer, right? But you can close the position at any time. So if I sold to open, I could turn around and I could buy to close and get out of that obligation to purchase the shares if I feel that it's no longer a good opportunity. Okay, so to sort of build on that, for those of you that kind of like the idea of utilizing put options as a way to generate some cash flow, but you're a little concerned, sort of to echo John's question about any sort of dramatic drop, what you can do is you could add what I would call a protective put to the strategy. So the bull put credit spread basically involves you selling the put and receiving a credit, no different than the last example that I shared. But then you're going to buy a put below the sold strike to limit the potential losses. So that way, if there is a substantial drop in the underlying security, you now have a protective put in there to make sure that those losses don't accelerate if the shares continue to sell off. Now, what we have to do, though, is we have to recognize that the cost of that, for lack of a better word, protective put it needs to be calculated into the overall income generated. So you've got to subtract that cost from the credit that you've received. And if the underlying shares are at or above the written strike price, you keep the credit, all options expire, and you've generated the cash flow. Now, that strategy is only permissible in non-registered accounts, so just keep that in mind as well, is that it's only permissible in non-registered accounts. Now, I'll circle back to Neil's question, which is asking, when I'm bullish on a stock, I like to write the bull put spread for income. Could I discuss this strategy versus the bull call spread, and when is it more efficient to use either one? Great question. What we want to recognize, if we compare just the two examples that we've been discussing, right? So when we look at the bull put spread, all right, and let's consider that we're going to sell the June 49 strike puts. We're going to collect $1.30, right? We're going to buy the 47 strike puts, and we're going to pay out 60 cents. What happens is we have now established a net credit. So Neil, keep in mind that that net credit is the most that you can generate, profit that you can generate from this trade. So in other words, the bull put spread is a great strategy when you really don't think that the stock is going to move all that much. You just think that it's going to stay at or above your written strike, and you just want to add a little bit of a protective strategy in there just in case the market goes the other way. So for the bull put spread, great for income generation, but you have a fixed profit point at which you're not going to be able to do any better regardless of where the stock goes. Okay, so if you felt the stock was really going to take off and you didn't want to limit your upside, you would use a call option. If you thought the stock was going to move higher and you wanted to use a call option, but you thought, hey, that call option's expensive and implied volatility is high, you might consider a bull call spread. You're still going to get the upside swing on the stock. You got a really nice risk reward opportunity there. In my example earlier on, it was a $3 risk for a $7 upside. So you got a real nice risk reward profile to consider, right? But if you were looking at that same stock and said, you know what, I don't think it's going to do a heck of a lot over the next month. I think it's just going to kind of chop around at this particular level. So let's just try to generate some cash flow off of it and do a bull put spread. That way, if the stock stays the same, goes up a little bit, goes down a little bit, I still get my net credit, and I can be very passive. I can just sit back and let the market do its thing. Now, the other consideration is when we're looking at the maximum risk, right? So when we consider the maximum risk on this strategy, it skews the risk reward profile, because if our maximum profit is the net credit of 70 cents, our maximum risk is calculated by taking the 49 strike put and subtracting the 47 strike put. So keep in mind, we have an obligation to buy the shares at 49. So think about this strategy. Let's reverse engineer this a little bit. This strategy is kind of like saying, okay, I'm going to buy the stock at 49 and I'm going to buy a 47 strike put. What you've done is you've limited your risk exposure to the $2 difference between the strike price less the premium that you've collected as a credit. So if you look at the risk reward profile here, Neil, and this is a good consideration as well, in this case, we're risking $1.30 to make 70 cents. So our risk is in fact higher than our profit potential. So we want to be comfortable with that, and we want to be confident that the stock is likely going to stay the same or go up in value, right? So hopefully that answered your question. Neither one is actually any more efficient than the other from a trading standpoint. They both require essentially the same trade logistics to enter in and to get out of, where you're a buyer and a seller at the same time. It really is just a matter of determining which one fits best with your outlook on the stock. The credit spread tends to be a little bit more passive. The debit spread you can manage a little bit more actively as the stock is trading towards your target to get out, to lock in profits, that sort of thing, right? So the other consideration is your break even on the bull put spread. It's the written strike price minus the credit. So basically, if the stock is trading anywhere at the $48.30 level, you have an obligation to buy the stock at 49. You have, but you collected 70 cents in premium, and so your break-even point on that is if the shares are trading at 48.30, you basically sell the stock for 48.30. You've collected 70 cents. You're at that $49 level there. Again, all of these strategies, just to go back to John's question about what if the stock drops or goes against you. It doesn't matter whether it's the call option, the bull call spread, the the covered call right. the put right or the bull put spread, you can get out of these positions at any time before expiration. So you can manage for risk or for profit at any time. To kind of circle back to the put right strategy, a good general rule of thumb is, if you have if the stock takes off and the put premium that you sold, let's say for $1, is now only worth 50 cents, and that's happened within let's say you sold it for a month out, and it's now worth 50 cents 3 days into the trade. Close the position, lock in that 50 cents, and look to maybe reestablish the position at a different strike price, right? So you can get out to manage risk or to lock in profits at any time, regardless of which strategy you choose to utilize out of these bullish strategy examples. Okay. So just to kind of build on that consideration, which strategy to utilize, what's your objective? Again, Neil, is it directional or is it income? If it's directional, you want to make sure that you're given as much upside as you can, and you've created a risk-reward scenario where you are taking less risk for a much higher and more attractive reward. If it's income, then again, that's where that bull put credit spread comes into play, where you're just looking to generate passive income on a monthly basis without being overly active, and just take advantage of the options expiring. And you're not too concerned about trying to maximize your profitability. You just want that cash flow. Registered versus non-registered. I've tried to touch on this within each strategy that we've discussed. Some strategies are permissible within your registered accounts. The long call position or long call strategy, so buying a call is permissible, and the covered call strategy is permissible both inside and outside your registered accounts. The bull call spread and the bull put credit spread is only permissible in your non-registered accounts. The other consideration is the size of your account, whether you have enough capital to participate in share ownership. Remember that each option contract has a 100 unit multiplier. So if you want to implement the covered call strategy, you need to hold at least 100 shares of the underlying security. So that may be a consideration for your tax-free savings account or non-registered or whatever, as you may not have enough shares within your account in order to implement that strategy. So are you looking to do what we would refer to as an options overlay? So your focus is building a diversified portfolio of stocks, and then you're implementing an options overlay, whether it's covered call writing to generate cash flow, whether it's put writing to establish positions. It's all centered around the idea that you want to own the stock. Or are you looking for stock replacement? So you want to hold as much cash as possible and just buy call options, create bull call spreads, do put rights, or subsequently sell bull put spreads in order to just eliminate the stock positions from your portfolio, hold as much cash as you can, and just use options as a stock replacement. So before we take questions, guys, lots of information available. You can check out our blog at optionmatters.ca. There's investor options trading letters, videos and webinars, trading guides and strategies, calculators and simulators, all available at m-x.ca as well as m-x.tv. As well as Conlieff indicated, our webinars are recorded and available to you for reference on demand. So with that in mind, certainly open to any more questions as we wrap up the hour here. And I guess I'll pass it back to you, Conlieff.
Thank you, Jason. That was very, very informative. Thank you so much. I don't note any additional questions for Jason, so we'll do the closing parts of the presentations. If you do have any other questions, feel free to type them in. If Jason is available, he can certainly address them, or I can send the questions over to him and get some answers back to you by email. So just let's moving forward then. As mentioned before, you can access the webinars on our YouTube channel, or you can email us at education@scotiaitrade.com to request copies of the recording link. Now, after you exit the webinar session, we will be uploading up a short survey, and we just ask that you please complete those, as we do review them and use them to continue to improve our educational offerings for you. So feel free to fill those out and add commentaries as you please, which will definitely help us with the situation here. So coming forward, we'll have another webinar with the market guys on Thursday, April 27th. This one is rapid fire analysis, which will just assist you with the technical analysis and the interpretation of the charts. And this is for the intermediate users. Also, Horizons will be with us on Tuesday, May 9th at 1 p.m. They'll be providing a webinar on leveraged and inverse leveraged ETFs. This will be for an advanced learner. So once again, Tuesday, May 9th, Horizons ETFs will be providing us with their webinar. One other thing to mention, on May 10th, on Wednesday, we will be placing another webinar on sustainable investing. So basically, Canadians are increasingly including their personal values and beliefs as integral parts of their investment strategy. So if you're one of those, I would welcome you to join in or to register for that sustainable investing webinar coming up on May 10th at 1 p.m. Here from Scotia iTRADE. We'll be having the folks from Sustainalytics provide that webinar to us. Here's where we can access the webinars and register for new webinars on the scotiaitrade.com website. Under the Education tab, just click on Events Calendar, and then you can either register for new and upcoming webinars, or you can just scroll down to the bottom to get our archived webinars as well too. So there, on behalf of Scotia iTRADE and the client education team, I want to thank Jason for that amazing presentation, and I'd also like to thank you for your attendance and for your loyalty, and thank you for attending the presentation, sticking with us. We hope to be able to provide more engaging content going forward based on your comments. So once again, thank you very much. If you just give me a few moments, I will upload the presentation for you now. A few more seconds. Done. Okay, the presentation in a bullish market is available for you to download, and the link, as I mentioned to you, to the actual recording will be sent out automatically tomorrow by email link. Thank you so much. Have a great afternoon, and we'll see you again.